Hello, hello. Good morning, everybody. So I'm delighted to be here. It's great to be here in person. We've lost the habit of being here in person, so it's great to be here and to have such a crowd here today. By way of introduction, I should say that I'm based near London. We are a team of 10 investment professionals. So I'm here to talk about Asian equities. We've been doing that managing Asian equities since 1998. So this particular strategy that I'm talking about today has quite a long track record. And I should say that, in terms of the 4 pillars of our investment approach, we are active stock pickers. We're looking to beat the market. The way we look at individual stocks, and there's about 50 or 60 stocks in the portfolio. And every stock that makes its way into the portfolio, we think, can deliver at least, double-digit annualized returns. That's our definition of an attractive investment. And when I say double-digit annualized returns, I mean over the next 3 to 5 years. So 10% per annum over the next 3 to 5 years. How do we do it? Well, we're fundamental managers, so we try to understand the businesses we invest in, and we assess what the fair value is, and we try to buy below that fair value. So we're very much of the motto, price is what you pay, value is what you get. And so you know what the value is, but you want to pay it when it's low. Thirdly, we are contrarian at the point of purchase, and this will be obvious as we go through the presentation. We do believe that, negativity in markets is a good thing for us because we can buy things on a low valuation. So we're contrarian at the point of purchase, but it's important, particularly in places like Asia, to ensure that when there are opportunities, and they may be contrarian, they may be temporary problems, that we can at least be reassured that there's a very strong balance sheet behind that idea. So those are the 4 pillars of our investment approach. Balance sheet strength is important, but also the upside potential is very important as well. So that's how we invest in Asia. Now, the interesting thing, and I'm going to show you a slide here. So if we look at Asia, this is the last 30 years looking at Asian markets. And as you can see, it's not a straight line. We were talking about a straight line earlier. It's quite volatile. This is actually a log scale, so that you can see the ups and downs a bit more clearly. But what's interesting is that we're back to pre-COVID levels in terms of Asian markets. Obviously, a huge round trip. We've seen a lot of volatility. We talked about growth and value earlier. The same has happened in Asia. We've had growth stocks perform extremely well for a period of time and then underperform. Value has caught up. We've seen cyclicals outperform more recently. And so it's been a great environment for active stock pickers, I think is the point I'd like to make. But although markets are where we were pre-COVID, the valuations are 20% cheaper. And that's because earnings have come through, but the market is pretty much flat. Now, obviously, we've had a bit of a roller coaster ride. So I would say it's been a very good period for stock pickers. Market hasn't done much, but we've outperformed by around 20% during that period. And that's because we've seen huge amounts of volatility that we've been able to capture at different times. And I think this is one of the advantages in Asia, is that it's a broad asset class. You have many countries, many sectors, many exposures. If you think about what's actually happened, we had China doing extremely well, Taiwan, Korea, markets doing extremely well when COVID hit, because obviously people were buying technology, were working from home, it was all about online. So, these sort of markets did quite well in that environment. And then we had India that got caught with COVID. There was a lot of negativity around India. Doesn't feel like that today, but there was a lot of negativity. And that was an opportunity to buy India when people were quite negative. At the same time, we had Indonesia sort of left behind, and even Thailand, in some way ignored by the market for a period of time. COVID didn't help, but certainly we had an opportunity to buy into those areas. And obviously Indonesia did quite well with commodity prices going up. And so, we sort of benefited from that. And then you had Korea, which was sort of ignored for a period of time. And we would argue ignored today, because the semiconductor cycle in Korea is poor at the moment. We're going through a typical capital cycle where we've had overinvestment. There were not enough chips. There was shortage of chips. And so companies, as a result of that, would start to produce more, increase their capacity. This is sort of the natural evolution of the capital cycle, which leads to a situation where there is enough capacity, but suddenly demand is starting to slow down, as we're seeing in the US, for example, in Europe. Growth is slowing down, and therefore we have a situation where the semiconductor cycle is at its worst at the moment. And so companies are starting to cut capex, they're cutting their investments, and so the cycle goes. Usually, this is a good time to be investing in the semiconductor cycle because we're at the trough margins. Utilization rates are down. That, for us, as contrarians, is an opportunity to look, or at least it's an invitation to go and have a look and decide whether they are attractive or not. And again, we need to assess fair value. So that's the sort of the background. And so what I'd like to talk about today really is just Asia. Where are we in terms of valuations and what we think? But also, if the last couple of years have been great for active stock pickers, what next? And I think, if we think about 2022 and how difficult a year it was, I did a similar presentation around maybe 3 or 4 months ago, and the title of my presentation was The Gift of Fear. And I think that's because, for us, fear is a gift. It's a gift offered by the markets to buy assets at cheap valuations. And of course, what's happened since is that China's recovered quite strongly. But if you think back 3 or 4 months ago, people were very fearful about China. It was almost uninvestable for many investors. Now, how did we react to that? Well, we found opportunities. We went from a 12% underweight in China to an overweight by the time the Chinese government came out with their pro-growth plan. So I think the important lesson, I think, for investors is that markets fluctuate. If you follow whatever or the rest of the market is doing, and as selling when you're cautious, but buying good stories, there's a risk that you're sort of late into that momentum trade. And so I think it's important as part of your portfolio to have at least some contrarian ideas. And so that would be the core message for me. But interestingly, if we think about 2022 and how difficult it's been, the US dollar has been strong. That's not good for Asia generally. Financial conditions have been tightening in the US and Europe. That, increasing interest rates, that tends to be an environment that's difficult for Asia. The zero COVID policy in China, that was obviously difficult for 2022. And just generally, growth has slowed down, and that's been reflected in valuations clearly. But it was almost a perfect storm in 2022. Now things started to change in Q4 last year with China reopening. But as we look at 2023, and I'll talk a little bit about valuation, but a lot of the fear is in the price, we feel. And we would argue that even with the rebound in China, and I'll talk a little bit about valuations, things are looking quite attractive still. If you've got a 3 to 5 year horizon looking at Asia, we're at a time when things are looking quite interesting. So let me quickly show you this slide, because I think this is interesting. I've sort of summarized what we think about the beta or Asian equities in 3 bullet points. The first bullet point is we have a significant valuation discount still Even though we've seen quite a rally over the last few months, we're still at a discount. We're looking at 1.5 times book value. That is low relative to history. We have 12 times or 13 times PE ratio. Again, that is quite low relative to history. We had a 30% discount to US equities. Now, that discount has been there for a while. But the question is, with the desynchronized economies that we're seeing, with China reopening, but the US still tightening, that discrepancy could mean that Asia doesn't deserve to be, particularly if it starts to see growth come through, deserve to be at these sort of valuations. So that's where we are. That's the valuation discount element, and I'll show a few slides to illustrate that. The second point is growth prospects. The second point I was making is about growth. So structural growth in Asia is still there, but it hasn't translated in earnings over the last decade or so. And with the new regime change, we think this could change for the next 10 years. So what are the structural growth? Well, the rising middle class is clearly something we can continue to take advantage of across Asia. The middle class is actually, according to the Asia Development Bank, is 3 times larger than it was a decade ago in Asia. So that's a lot of consumers. That's a lot of demand for products across the region. The second point is, when we're thinking about structural growth, is people are concerned about the slowdown in the US and what that means for Asian exports. And we're concerned about that as well, because clearly Asia does rely on exports from the West. But I think it's important to frame it also in the sense of, Asia, intra-Asia trade is larger now than trade with Europe, trade with the US, and has been growing. And so intra-Asia trade is becoming more and more important. And I think, as investors across Asia who need to choose 50 stocks out of the thousands that are available, we can choose companies that can take advantage of, the middle class trade across the region, which is continuing to be strong. And we've talked about some trade reforms that have gone through across different countries. ASEAN is obviously one example of that, where things are there's an impetus there to do more trade with our neighbors. And so, there's a few elements there that are quite positive. But when it comes to earnings, so that's the structural growth, what about the cyclical growth, in terms of earnings? Well, China reopening is big news. The consumers are going to come back to the fore. There will be more traveling. Now, China's focused more on its traveling and going to see family initially, but gradually over time, you would expect the Chinese to start to go across borders, across the region. That does mean more consumer demand. And so that's a positive. That's a positive for revenue growth. So that's the first, I would say, data point in terms of estimating where earnings is going to go. The second point is margins. We've seen the commodity hikes. We've seen the prices increase over the last few years. That has been difficult for companies because their margins have come down. Input costs have gone up, so margins have come down. And that's been reflected by the market. And so where do we go from here? Well, commodity prices are starting to decline again. They're still high, but we don't have that strong growth that we saw during COVID or following the war between Russia and Ukraine. And so with that impetus for commodity prices to go up isn't there as much as it was following that event. But of course, we may see inflation sort of remain reasonably high, and that's why I talk about regime change. Inflation might remain higher in the Western world, and commodity prices may stabilize at a higher level, but the delta, the growth in commodity prices, the impetus isn't as strong. And so that means that companies that can help themselves, that can cut costs, should be able to maintain margins at a higher level now. So we've got revenue growth, we've got margins that are looking better suited for the future. And the way we see things is, I talked about the 10% returns that we're looking to achieve when we invest in a company. Well, there's 3 components to those returns. First component is growth, and I've talked a little bit about growth. The second component is the valuation change. And what we saw, and I'll talk about valuations, but what we saw when people were very euphoric about Chinese internet, about technology, about growth stocks, what we saw is a valuation derating. And that's why you saw the growth part of the market underperform. And fortunately, we don't like to bake in optimistic assumptions when we're investing. We prefer to invest in something with and bake in, assumptions that are reasonable and not too optimistic. And so we were underweight the Chinese internet. We were underweight tech at that point. And so we benefited from that, protected our clients' capital. But that's the second component, valuation change. And the risks are not as strong as they were. And the third component, so I've talked about business growth, valuation change, and the third component is dividends. And actually our portfolio, and it's interesting, people don't realize this, but Asia does offer good dividend yields now compared to maybe where we were 10 years ago. And even Korea, which is seen as a laggard in terms of dividends, a lot of companies are paying out more to shareholders. And so a dividend yield is around 3% in Asia as a whole. Now, if we look at the 100 stocks that we have selected across our team, there's around 50% of those that deliver a dividend yield above 4%. So, Asia does offer good dividend yields as well. It's not just about growth and valuation, there's also dividends. And so those three components put together is our way of looking at what delivers total returns. And so that's how we analyze stocks. And the interesting thing is that if you think back a couple of years ago, we have a company shortlist of around 100 stocks. Now, most of the stock at the top of that list, in terms of the highest returns, were value stocks. They were cyclical stocks. We didn't need to bake in high assumptions. And that's because earnings growth was recovering. Valuations were already quite low for cyclical stocks, and they had good dividend yields. Whereas growth stocks, they had good growth, but maybe a bit too optimistic. Valuations were very high, and they didn't have any dividends. And so the valuation fall has meant that performance has been quite poor in that part of the market. So again, we love growth stocks. We just don't want to overpay for them. So those are the points I would make about growth. And the third point I'd make on why Asia is attractive is where we are today. Compared to the US, they're catching up. They were obviously late in their tightening cycle. Inflation is quite high. And Asia is sort of used to having inflation at a higher level compared to the West. But inflation isn't an issue in Asia at the moment. And that's because they haven't stimulated as much during COVID. Now, that might have made life difficult, but it also means that money supply is not as abundant, and it means that inflation pressures are more subdued than they are in the US. So that's an interesting dynamic because it means less requirement for Asia to tighten the way the US has. And so when we're talking about the China rebound or the recovery, this is in the context of inflation being pretty normal across Asia. It probably doesn't feel like that sometimes, when you're buying, you're going shopping. But when we look at the numbers, inflation is a lot more normal. So let me quickly go through a few slides and just to sort of elaborate on what I've just said. So this is the first slide, which is the price-to-book ratio of the market over the last couple of decades. And you can see that there's only 3 times in the last decade where the market has been as cheap as it is today. And a lot of that is because of the negativity of 2022. Now, yes, we've seen a recovery, but the market is still pretty negative, gloomy as a whole. And so you can see valuation levels are well below historical levels. And the red circles there show you, where we've been, so the trough in the cycle. But what's interesting also is the shaded blue area. The shaded blue area shows you, as an active manager, how we have performed in those sort of environments. And I think there's a correlation between how well we do over the next 3 years and at what point we buy the market. So at the moment, if you listen to our discussions around the desk, we're pretty excited. A lot of companies are trading on valuations that are attractive to us, and this is reflected on this slide. So what does that mean? Well, it means that at these valuation levels, not only does the market do well, typically, but also we have a greater propensity to deliver alpha, to deliver outperformance. So that's the interesting point. Now, just to show you that in numbers, so this is a slide showing you if you bought the market at a certain valuation level, what type of returns would you get over the next 5 years? And if you think back about 2 years ago when we were much more cautious about the market, you could see that the market was trading on 2.1 times book value. This was in February 21. That was the peak of the market. We were a lot more cautious. We could see that, historically, you would have delivered negative returns per annum for the next 5 years at those valuation levels. Now, fast forward to today, and I've used December 2022 numbers, 1.5 times book. Historically, that suggests that your future returns are decent, 9.2%. You add inflation on top of that, and we would hope to add alpha on top of that. And so we're in a much better situation than we were, 18 months ago or a couple of years ago in terms of, where we are in markets. This is the responsible policy I was talking about. So as you can see, inflation in Asia is not as under pressure as you can see in the US, Europe, the UK. And again, that's a good state of affairs. The second chart is showing you the China impulse. And this is actually as of October 22. So, the impulse was already showing up in the numbers before they came out and decided, China came out and decided that zero COVID policy was a thing of the past. The way we think about China, and the reason we went from an underweight to an overweight during 2022, is there were 5 problems in China that markets were worried about. The first one is obviously the zero COVID policy, which is very difficult for the economy to do well in that environment. Zero COVID policy. The second one was regulation of some industries, particularly the Chinese internet sector. And that's one of the reasons I think that the sector suffered quite badly, given that valuations had certainly not priced that in. So regulation was the second issue. The third issue was property. I mean, property is, sort of 15% or 20% of the economy. So a clampdown on property represents a risk. And the fourth point is obviously the geopolitics, just generally with the US, and something that is difficult. Some people ask us what's going to happen in Taiwan. Nobody knows, and we don't try to spend any time trying to predict that. It's a low probability event that something happens, but there is a probability. Now, we're not in the business of positioning a portfolio for low probability events. We're in the business of trying to make money by investing in companies. But it is something to bear in mind, and it might mean that China should trade at a valuation discount. And so that's something that's fair enough, but certainly very difficult to predict what might happen there. But I think investors, the mistake they made is to assume that China was the same as Russia. And I think that has meant that they've missed the China rally by being too focused on geopolitics, whereas there's many other things that drive markets. But that was the fourth issue that people were concerned about. And the fifth issue is the consolidation of power in China. So that is something that has kept people cautious about China. The feeling that the people around President Xi can't challenge him, and therefore the the power of debating, the power of information is not as strong. Now, I think in some ways, the mistake was that nothing would change in China. Clearly, things change. So the policy was pro-growth as at the end of the National Party Congress. So we would say that is probably, when you think about these 5 issues and what's happened since, the consolidation of power has not led to bad policy so far. Geopolitics, that's still an issue, and we think it's going to be around for a long time. Regulation has turned positive. Property market, there are a lot of measures coming through to support people so they can buy their property. Mortgage rates have come down. The banks are lending again. So that's a positive. And the final point is regulation. So the regulation towards the internet sector is much more positive now. Just looking at gaming, for example, the licenses for games, there's quite a few licenses that have been accepted. And so companies like Tencent, NetEase, companies can start, developing business in their gaming business. So there's a lot of things that have changed for the positive. And I think the China credit impulse on top of that suggests that, it's sort of, in a way, it's in the news now. But the point was, regulation, the property sector, and zero COVID, they were bound to end at some point. We took the view that they would end at some point. We didn't know when, and actually it came earlier than we expected, but we thought they would end at some point, and that's why we went overweight China. But there are many other markets where you can make that conclusion. You could say, well, people are too pessimistic about the semiconductor cycle. People are too pessimistic about real estate because interest rates have been going up. A lot of people are negative on growth stocks now because inflation is higher. The valuation of some of the growth sector has come down significantly. Some stocks are down 80%. Now, it's been great to avoid that, but it also means that maybe there are opportunities now to buy some of these companies at much lower valuations. And so when you look at how we're positioned, we're not trying to take a view on predict the economy, predict where the market is going to go. All we know is that valuations are looking interesting. We also know that we will be surprised by things. We're always surprised. I showed you a chart earlier about share prices and what happens to share prices. There's always something that comes around the corner and surprises us. We have to, rather than try to predict those, we just need to have a portfolio that is resilient. And I think that's one of the lessons that we've learned over the last few years. There have been so many surprises. It's important to have a resilient portfolio, to have a balanced portfolio, not to rely on one outcome, only growth stocks, for example, or only value stocks, or only China. That's the advantage that we have, is to have an Asia portfolio, a mixture, a balance of value and growth. As you can see on this slide, the areas we like technology. I've talked about the semiconductor cycle. We like the consumer. China reopening, that's going to spread out across Asia, we feel. The internet sector has become interesting again. But you can see we also own cyclicals: autos, real estate, insurance, banking. And you could say that autos, real estate, insurance, banking are part of the consumer play that we see across Asia. It's just a different way of having exposure to the consumer across Asia. So we're overweight Indonesia, we're overweight Korea, we're overweight Hong Kong and China. We're underweight India. We think it's still too expensive. It's about 3 times as expensive as China, for example. And so we do like India as a long-term investment opportunity. But again, we want to be selective, and we want to enter when the price is right. And we don't think we're there yet. Now, the good thing is that India, you could see, has wobbled. There's been a few issues around corruption, and so people have been a bit more concerned about India. Now, we didn't own any of the stocks that are in the news, but it's interesting to see that the market has come down quite significantly. So we're starting to look at India again. Because again, India is really a good long-term story. The credit cycle is really early, and so we would like to take advantage of that. So we do own some Indian stocks, but we're underweight. And As you might expect, given the contrarian approach, given the valuation approach, the areas we don't like are what we consider expensive. So we still think Indian IT providers are expensive. The EV pure plays, we find them still expensive. Some of them don't make money, they're unprofitable. Healthcare is still expensive, we think. We prefer to play the insurance, to have exposure to healthcare. Unprofitable tech and internet, we don't own that. We don't own over-leveraged property developers, for example, in China. And we don't own companies that don't have pricing power, or at least we try to avoid those. So that's how we distinguish what's attractive, what's not attractive. I'll pause there, but hopefully that was useful. And thank you very much for your time.